The weakest economic growth since 2001. Financial institutions warn of a global recession in 2023.
Inflation in the United States has hit 4-decade high. Lower-income households face the worst of the crisis.
In May, inflation hit 8.6%, the highest in 40 years.
Venezuela are now worth next to nothing due to the sky-high levels of inflation.
Also to start the year, well, going in the opposite direction is the dollar. Weakness here has persisted now for several weeks. In fact, this is a downturn that really started late last year.
The dollar is still the world reserve currency, despite decades of being challenged, especially more recently by the BRICS countries of Brazil, Russia, India, China, and South Africa. Like it or not, the dollar's success and the success of the United States is the barometer for the larger global economy. But recently, the world's barometer hasn't been doing so well, and the rest of the world has felt it. In this video, let's talk about why the US economy is so critical to the rest of the world, how its surging inflation caused a global depression, and why the long-lasting effects will be felt the most by BRICS and other emerging markets. But before we talk about what's going on today, let's start with how we even got here in the first place. In July of 2019, the United States went 121 consecutive months with economic gains, making it the largest streak in US history. The stock market was at its highest in the last 6 years, with the S&P 500 up a crazy 28%. And according to the Bureau of Labor Statistics, 2019 was also great for jobs, as unemployment was at its best rate since 1969. But then the unthinkable happened. In February 2020, stock markets across the world suddenly crashed after tremendous uncertainty due to the COVID-19 pandemic. And the US was no different. The US stock market fell over 30%, the biggest, fastest drop since the Great Depression, and unemployment rose to 14.7%, the highest since, you guessed it, the Great Depression. To combat this, the Federal Reserve cut its federal funds rate to basically zero, which helped support spending by lowering the cost of borrowing for households and businesses. Additionally, the Fed implemented something called quantitative easing. Quantitative easing is when central banks, like the Fed, buy government bonds and other securities, injecting bank reserves back into the economy. It's also just a fancy way to say they're printing more money to help boost the economy. Increasing the money supply lowers interest rates further and provides liquidity to the banking system, allowing banks to lend with easier terms. An important side effect of quantitative easing is the currency, in this case the US dollar, gets devalued, raising the value of other currencies against the dollar. And in 2020 alone, the US printed over $3 trillion, which was approximately 1/5 of all the dollars in circulation at that time. When the value of the dollar drops, it diminishes its purchasing power internationally, which eventually translates to the consumer level. It also creates more demand for US exports, raising the price of US exports to other countries, which eventually forces those countries to raise their own prices in their domestic market. And when price increases happen for multiple goods and services in countries around the world, that's when you start to see the rise of global inflation. This is why the dollar, the world reserve currency, has been in control for so long. Every little move it makes has such a huge impact around the world. And every month when the Federal Reserve Chair Jerome Powell steps to the podium to talk about the Fed's monetary plans, countries around the world wait with bated breath, knowing that they're at the mercy of the US economy and the dollar. But this is the exact reason why emerging markets are done bowing down to the dollar and are looking for ways to eliminate their reliance on the dollar and the United States. In fact, China has come out and warned developed countries like the United States of raising interest rates too quickly. And the UN called on some of the top central banks in the world to stop rate hikes. If you like these news-related videos about the global impact of the US dollar and want to see more of them, make sure to subscribe to the channel. Now let's transition to how all this impacts what's happening today, because there is some alarming information out there right now. While many Americans have struggled to get through the fastest rate hikes at any point in US history and the highest inflation since 1980, emerging and developing markets have had it so much worse. Leading the way is Venezuela, with an unfathomable inflation rate of 400%, followed by Zimbabwe, Argentina, Sudan, and Turkey to round out the top 5. In total, there are 41 countries who have a current interest rate of 10% or higher. And according to the World Bank, 9% of the world, or over 700 million people, live in extreme poverty, earning less than $2.15 per day. And all this doesn't even include the facts from the World Bank's most recent report, which warns of a lost decade economically around the world. Even the title of their article doesn't provide much hope. sharp, long-lasting slowdown to hit developing countries hard. According to the World Bank, the global economy is fragile right now, and the main reasons why the global outlook is so negative stem from high inflation, fast rate hikes, of course the pandemic, and escalating geopolitical tensions. This is not new information, of course, but the reason why it's so significant is because it seems like what we're being told, especially by the Fed, is that this economic downturn is short-lived. But with this new report, the World Bank is saying the complete opposite. They estimate the global economy to grow by 1.7% in 2023, which is actually down from their estimate of 3% just 6 months ago. And they project 2024 to grow 2.7%. As bad as the world poverty already is, they expect poverty to continue to rise, especially for those countries that have been dealing with this historically. By the end of 2024, GDP levels in emerging and developing economies are estimated to be 6% below the levels right before the pandemic, meaning these countries' economies still haven't caught up to the pre-pandemic totals. More simply, the World Bank is being very transparent that there is no expectation for these things to improve in the near future. The World Bank Group president even said this: emerging and developing countries are facing a multi-year period of slow growth driven by heavy debt burdens and weak investment as global capital is absorbed by advancing economies faced with extremely high government debt levels and rising interest rates. Okay, we get it. You're talking about the United States. The World Bank offered up some suggestions of how the global economy could actually reverse the trajectory it's been on. Now, to find these suggestions, I dove deep into this 198-page document. So if you appreciate that and want to let the YouTube algorithm know, make sure to smash the like button. These ideas are all common sense and none of them are really unique, but since it seems like all the governments are doing the complete opposite of what common sense would suggest, I thought I'd share. So Jerome, if you're watching, make sure to take some notes. The report obviously suggests to focus on reducing the national debt levels. Now, we know this is something that the US is doing the complete opposite of, because as of right now, there's no cap to government spending through 2025 as a result of the debt ceiling standoff. Instead of fixing the problem, they're just kicking the can down the road. Rest easy, Jerome. This one's not on you. The World Bank also suggested that the most promising way to improve growth around the world is to ensure a high level of what they call labor force participation. This seems like something that everyone should be on board for. If more people are working, more people have more money that they can spend back into the economy. But if the interest rates continue to rise as they're expected for the next couple of years, it's very hard to see the labor force increasing. And in fact, most likely the opposite's gonna happen and we'll see higher unemployment. So what the World Bank is basically telling you, Jerome, is to stop with the damn rate hikes. So while the BRICS countries and friends are doing everything in their power to dislodge the dollar, this report is even more proof that we have a long way to go for that to happen. The strength of the dollar and the US economy are just too powerful globally for any major changes to happen with the dollar and its world reserve currency status. The hatred of the dollar around the world is clear, but what are the BRICS countries doing specifically to reduce the need of the United States and the dollar? I go over all that in this video here.